Okay. Good morning, everyone. Thanks for joining. So in this session, we'll be discussing private assets and their role in accelerating the climate transition. The race to develop new alternative energy sources and other low carbon solutions, it's shaping up to be quite the generational opportunity to put more money to work. Companies supplying the technology, products and services that will drive the shift away from carbon, they all stretch across the global economy. And they'll need trillions in new capital as the world strives to ward off the worst of climate change. And it's easy enough to say that the energy transition is opening up investment opportunities, but making sense of the evolving landscape can be quite challenging for any investor. And so to illuminate the risks, opportunities, and challenges in the private space, I'm joined here today by our esteemed panelists from KKR, Bain & Company, Wollemi Capital, and the New York City Comptroller's Office. So if we can start with a quick round of intros, if I can ask the panelists to kindly introduce themselves, starting with John.
Okay, good morning. My name is John Adler. I'm Chief ESG Officer for the New York City Comptroller's Office. We're investment advisor to the 5 New York City pension funds that total about $260 billion in AUM.
Hello, Chris Magalhaes with Wollemi. I am a director at Wollemi. I'm also launching the New York office and spearheading the company's project and structured finance capacity. Wollemi is a global climate investment firm. We have a balance sheet through which we issue shares to investors. And with that capital, we then make investments in climate companies and/or projects. We can do both corporate level investments and project or asset level investments. And we position ourselves as a growth equity investor, bridging the gap between early stage VC and later stage private equity.
Great. Hi, good morning. My name is Marc Lino. I'm a partner with Bain & Company. And I'd like to say I've got the best job at my firm. And that's because I lead our efforts around sustainability and private markets. Bain & Company, we're a global advisory firm. We are the leading investor to private investors and really feel it is our mission to help the industry accelerate change and create economic value. So happy to be here today.
And I'm Emmanuel Lagarrigue. I've been in the business of decarbonization for a large part of my career, probably almost 20 years now. First from the corporate, from the balance sheet of a large corporation, a large Fortune 500, and then working for a growth equity fund. And I joined KKR a few months ago to launch a new climate strategy as a partner, and where I'm the co-head of climate.
Thanks. My name is Rumi. I sit within MSCI's ESG research team covering ESG and climate funds research for the past 2.5 years or so. Before that, I was at JP Morgan and BNY Mellon. And I actually started my career in the energy sector at Shell, trying to maximize oil recovery in the North Sea. So today I'm here paying for my sins, talking to you all about the energy transition. So I guess to kick things off, Emmanuel, if I may ask, climate change, as we all know, it's creating quite a lot of opportunities for private investments, as well as generating new risks and opportunities for investors. Can you give us a sense of some of the conversations you're having with clients? Do they focus more on risks or opportunities?
I think if you look at capital formation in climate, there are 2 things you have to keep in mind. So the first one is that it's not only about energy, right? So immediately our mind goes to, we have to decarbonize the energy system and remove fossil fuels and go more electric. And yes, that's a good start, but it's 25% of the problem, right? So you have to decarbonize the rest of the physical economy. How do you create a full value chain and supply chain to make batteries and electric cars? How do you decarbonize steel, cement, shipping, aviation, fertilizers, and so on and so forth? How do you decarbonize the food and agriculture system, which is probably one of the worst offenders now? So that's idea number 1. It's not only about energy, it's the entire spectrum of the physical economy. And idea number 2, at least that's how we see it at KKR. Today, there's a good amount of capital being deployed in climate. Roughly $1 trillion, $1.5 trillion, depending on who you ask. So it's not too bad. But that capital comes in 2 flavors. You have a very strong ecosystem of climate tech, growth equity, early stage, which is needed to de-risk all the technologies we are going to need. And then on the other hand, you have large-scale infrastructure funds, which are basically focusing on wind and solar, which again is interesting, is needed, but not enough. And what we have identified is that in the middle, you still need large amounts of capital to be deployed. Probably another 5 to 6 trillion a year in the rest of the physical economy to be deployed at scale in those adventures.
Thanks, Emmanuel. So definitely need for action across the spectrum. Marc, can you provide some additional perspective here with regards to how private equity can drive decarbonization while creating economic value?
Great, no, definitely. And Emmanuel, you must be an ex-consultant because you mentioned 2 reasons. And actually, we see 2 reasons as well. First is investing in companies that are enablers. A great example of this is TPG Rise recently participated in Series C for Persephone. Full disclosure, we also are partners and investors in Persephone, but they are a leading carbon accounting and management platform. And if you see the growth trajectory of businesses such as Persephone and the opportunities ahead, it's a very steep curve. So we're seeing lots of activity, and Chris, I know you're active in that space as well. The second area is around using decarbonization as a value creation lever in the portfolio. We have one client who, quote unquote, runs to carbon. They've had years of actually driving decarbonization as a value creation lever. And so they actually are looking to find high emitters in industries that they believe that they can make them winners. And it has a positive outcome on GHG emissions, but secondly, they feel that they can get the economic rewards associated with that as well. So those are 2 main themes we're seeing.
Thanks, Marc. Chris, could you add some color as well from a early stage VC perspective, and maybe perhaps comment on kind of, because I see there's 2 issues here. There's decarbonizing existing portfolios, but also systemic global decarbonization as well.
Yeah, and to add on to that, so we are a climate-focused firm, so everything we do has a decarbonization lens. And to the first point made, it's not just energy. So we think about it in terms of 3 buckets. We have our first bucket, which is natural capital, conservation, reforestation, and the like. The second bucket is food and ag tech. And then the third bucket is everything that was mentioned. You do have energy generation, you have clean mobility, you have materials, building material supplies, et cetera, and decarbonization through all of the above. So everything that we do from both a portfolio perspective as well as a global market environmental perspective has a greenhouse gas emission reduction lens. The second point about the amount of capital and the gaps, we agree. Our approach is to try and crowd in additional capital. And as an example, we can come up to a company that is raising a Series B. And really, so they're well capitalized from the Series A. They haven't really gone through a rigorous diligence process, and they've got some hard assets that they need to capitalize. And so we can come in and we can provide $5 to $10 million in that Series B, and also equip them with a $25 to $50 million multi-draw project financing facility, with the goal of doing 2 things. One is playing well in the sandbox with the existing investors and the existing capital stack, and then 2, situating that company so that when it's ready for its next capital raise, that they are succeeding on all of the levels that institutional capital will want to see.
Thanks, Chris. And John, from an LP perspective, could you comment on your thoughts on this and the kind of conversations you're having with your GPs?
Sure. So we are totally externally managed, right? So we are dependent on our GPs, and essentially I would say, there are some funds, not that many, that we're invested in that are strictly climate solutions, TPG Rise Climate being one of them, and in private equity and private credit. We don't invest, or at least we haven't invested in any climate-only infrastructure funds or real estate funds. But we do talk to those folks, and they are making investments in the climate space. I would say in all of the types of investments that you guys have described. We have a goal that we've set for our 5 systems of $50 billion invested in climate solutions by 2035. We're currently at about $8 billion. And for perspective, that $8 billion represents about 3% of our current AUM. And $50 billion, we projected about 14% of our AUM in 2035. So we're definitely looking to ramp up our investments in climate solutions. And ideally that's concomitant with the additional investment that Emmanuel cited that we need in order to achieve the goals of the Paris Agreement.
Thanks, John. So let's dig a bit deeper into different asset classes, as I'm sure there are different factors and nuances to consider depending on the private asset class. Emmanuel, can you speak to some specific risks and opportunities and challenges you see in the infrastructure space?
Yeah, so at KKR, we came to the conclusion that that gap in the middle, right? So again, on one hand, you have a very rich and very competent ecosystem of I would say early stage and growth equity. I mean, TPG is a great example. Funds which are doing a great job and needed, but that gap in the middle, where you basically have to start underwriting industrial assets with an infrastructure portfolio. So when we say we are going to the climate strategy we are launching now, we are going to give it a very strong infra spin. That doesn't mean that it's going to be infrastructures in the classic sense of toll roads and telecom and things. No, there is a lot of industrial assets. But now, if you want to stand up a gigafactory, it's going to cost you a couple of billions. So when you reach that point, there is no technology risk. It's hard assets, so that you have downside protections. You usually have a very strong contract from an auto OEM that's just told you that they like your batteries, they are ready to sign a 10-year offtake contract. So you have guaranteed cash flows, downside protections, hard assets. So even though it's an industrial scale-up, it looks like an infrastructure. So this is why we have decided to incubate this new strategy within the infrastructure platform at KKR, because we think that's what's missing. And to John's point, right? So that's a good illustration. Those scale-ups will come a lot with infra-like opportunities and risk.
That's good to hear. I mean, from a public perspective, I can say that having looked at the public universe of funds, there's zero to little climate-focused infrastructure funds available out there. But it's good to see that on the private space that gap is being serviced. Marc, can you provide some private equity perspective here? Any nuances to consider in that space?
Yeah, no, definitely. And I think in private equity, we're seeing it across different sectors. We had a client in the building material supply business, and really 4 benefits that they saw from it. Number one, in RFPs, more and more climate and other ESG factors were decision criteria. And so being able to pivot to being able to supply those types of products was an ability for them to gain share, but also to get some margin as well, because typically those products are higher margin. Secondly, there was a cost angle to it, and this is almost basic sort of performance improvement, but they had a huge route optimization opportunity, and not only did that lower their sort of fuel costs, but it also lowered their GHG emissions. Cost of capital was part of it as well, so they went out and the green bond market is very well established, particularly this is in Europe, so it was an easy market to tap. They were able to save 3 basis points by hitting a few KPIs that they agreed with the lenders. And last but not least, and this is the one that really surprised us, is by doing this, they actually had much higher employee engagement and employee satisfaction, and we saw churn go down. And so, because the employees felt like they were working with a business that had purpose. So quite interesting to see how in even sort of an old school asset like a distribution supply business, you see these opportunities.
That's very interesting. Chris, can you add some color on the VC early stage side, risks and opportunities as well?
Sure. There's just a lot going on in the market, so it's certainly an exciting time. And I think everything on this panel so far said really well. We too take an approach to try and make something infrastructure-like, even if it is not infrastructure. And we have a really simple framework, which is looking to understand and mitigate market or demand risk, whether through some type of off-taker or otherwise, as well as minimizing technology risk. One of the things that we've been really focused on is, especially at the earlier stage of companies' life, really understanding what their identity is and what it is they're trying to be. So, for example, you may have a tech-enabled developer. Fundamentally, are they a developer? Is that what their core competency is? Or are they a technology company? Or are they trying to be a little bit of both? So it's understanding where they're at, and then hopefully them being at the inflection point where all they need is capital in order to grow. Maybe that means that they're not pre-revenue anymore. Maybe that means that they've demonstrated product market fit. Maybe that means that they have a really good project and we're just going to go in at the project level, and by financing the project, we elevate the corporate parent company to then continue to grow. So there's a number of ways that we can approach it, but it's all based on the fundamentals that I've been talking about here, which is what are you doing, who are you trying to be, what are the risks, what are the cash flows, and then hopefully having gone through a process with us, that company is going to be well situated to continue down their growth path and their capitalization path.
Thanks, Chris. I mean, speaking of fundamentals, John, again, from an LP perspective, are there any differences in your climate-related assessment for different private asset classes?
Certainly there are differences. Starting with infrastructure, there's just a ton of opportunities in infrastructure, right? And obviously there's a lot of capital flowing into renewables, to solar, to wind, to offshore wind. But there's other opportunities too. We've seen a number of EV charging infrastructure deals, data centers that use renewable power, some other electrification stuff. So it just seems like there's a ton of opportunities in infrastructure. And again, we have only invested in diversified infrastructure funds, like the KKR Infrastructure Fund and many others. We're not, at least to date, we're not investing in climate-only infrastructure. Private equity, there seems like there's a lot of IRA incentivized activity. The battery manufacturing. And the line between infrastructure and private equity can be blurred, as I think, Chris, you were just describing. So there's some utility scale solar in the private equity. There's a lot of software stuff that's related to, either driving solar adoption or solar production as well. There's a ton of software that's in this space to make operations more efficient and so on. And then there's a lot in alternative credit, and not just green bonds. Honestly, I think of green bonds primarily as public. Alternative credit, there's just a ton of primary finance going into fund climate transition opportunities. And there are some climate-specific funds that are out there that we've invested in, as well as more general funds, alternative credit with specific strategies, whether it's direct lending or other sorts of stuff. And in some ways, the biggest difference is the risk-return profile. They each have their own risk-return profile, but there's plenty of opportunities in all of those asset classes, I feel like, to invest in climate solutions or the climate transition.
Let's discuss target setting for a bit. As a former LP, when speaking to private managers, often I've heard them say, we're in the closed-end fund business. Nothing we own today, we will own in 2050. So how can net zero targets work in this space with integrity and serious commitment? I'll start by posing this question to you first, Chris.
Sure. So we're an investment firm, which means that we have a lot of flexibility in terms of how we hold and how we monetize our investments. At the one end, we can hold an investment into perpetuity. On the other end, we can sell off either a whole position or a partial position within 5 to 7 years. So with that flexible approach, we always want to make sure that the targets that are being set by a company are going to be lasting, and that really applies across that spectrum. Because if we're holding onto it into perpetuity, we want to see that company succeeding, and if we're going to sell it, then the next investor that's going to come in is going to have a certain set of expectations that hopefully the company is able to abide by and succeed with. So in both cases, our flexibility means that we focus very much on what the company is trying to do and making sure that there are achievable targets for that success.
Marc, any views from you?
Yeah, no, definitely. It's a very a common thing we've heard. Over the past year, we've had the pleasure of working with the Initiative Climate International, as well as the Private Equity Sustainable Markets Initiative, with the goal of creating a common way for talking about where portfolio companies are in their decarbonization journey. And if you speak to GPs and LPs, and we spoke to 200 GPs, 50 LPs, one of the main issues was really how do you, when you think about net zero being 2050, how do you actually show progress between now and then in a way that is simple and compelling? And so that's, and quite excitingly, we started this week rolling that out. It'll be published in about a week, but with the end goal of having a common way of talking about how a business, how an individual portfolio company is making that journey. And we're quite excited. I think we'll talk about it a little bit later, but just in terms of the signals of adoption are quite high right now. So I think we're going to get there. And we just need to start, we need to find meaningful, simple ways to demonstrate progress today so that we can make sure that we can get to 2050 smoothly.
Okay. Emmanuel, how would you say targets work in the infrastructure space?
So there are two things here. So on one hand, for this climate infrastructure fund that we are setting up, it's only about climate. So there's a very specific climate framework. You want to make sure that the carbon emissions we're going to abate, remove, or eliminate are significant, relevant, credible, measurable. So and sometimes when you push this, you really have to. I mean, it's all about data, and there's no real framework out there. I mean, you can try to take Article 8, Article 9, and all this, but that's not enough. You have to go further than this. So that's one thing. So we do this for this climate fund. We do this also for our global impact fund, which is broader mid-market ESG fund. Now, for the rest of the strategies, regardless of when a company is going to leave the portfolio, we are working on a net zero path for each one of them. So today, 80% of the KKR portfolio companies have a net zero plan. Sometimes it's 2040, sometimes it's 2050. And again, regardless of when we think they will leave the portfolio, we are working on it because simply it's good business. Right? So it's value creation, it's responsible, but it's also value creation, and we know that whenever that exit happens, that having a net zero plan and a consequent one is going to be a value accretive.
Okay. I will come back to you on data reporting and framework shortly. Yeah. But finally, John, in your interactions, what kind of questions do you ask about targets, and what do you hear back?
So 3 of our 5 boards have set a goal of net zero by 2040. And just over the last few months, we have communicated the expectations of those boards to all of our managers, and we have about 250 managers, that they, by 2025 or 2026, depending on which board, that they either set a net zero goal and plan to achieve it, or the alternative for the private markets funds that say, hey, we don't own anything today, we're going to own by 2050 or 2040. We say, okay, then what we want you to do is commit that during the holding period, you will have your portfolio companies either adopt a net zero goal or science-based targets or some science-based pathway towards decarbonization during your holding period. Which is, I think, similar to what Emmanuel's talking about, what KKR is doing across most of its portfolio. So that's what we're asking all of our private managers to do. We have just communicated that over the summer, and so I don't really have a report back as to what the reactions are. Come back to me next year, and actually later this year, I'll be able to tell you sort of what our status is. But that's our expectation. And so, frankly, if a private manager comes back to us for a re-up or a new commitment post-2025 without net zero or similar commitment, I don't think they're going to get very far with those 3 boards.
Okay. Well, I look forward to asking you the same question this time next year.
Okay.
See what you have to say.
If you're lobbying to get on this panel again.
No, please, I'm not.
I thought that wasn't allowed. But,
you can ask me privately.
Okay. Back to data frameworks and reporting. You know, I'm sure everyone here is aware. You know, as climate's been gaining momentum in the private space, we've seen the launch of multiple industry-led initiatives focusing on data, transparency, standardized reporting, and some of these include ICI, PESMIT, Private Market Decarbonization Roadmap, the ESG Data Convergence Initiative, and of course also the IIGCC Net Zero Investor Framework. Marc, can you comment on the efficacy of these initiatives and what it will take to actually make them successful?
Yeah, no, thanks. Definitely, and number one, we do believe it's actually a positive sign that the industry has got multiple different initiatives focusing on this, because it shows sort of the eagerness and the willingness to drive positive outcomes. And it's relatively early days as well, if you think about it. So I think the number of different initiatives is a positive thing. I think, though, the measure of success is adoption. And if you think about what drives adoption, it's going to be simplicity, and it's going to be convergence. And so one of the things that as we were developing the private markets decarbonization roadmap was to be as inclusive as possible. So we worked very closely, ICI worked very closely with the EDCI. EDCI recently announced some metrics around decarbonization, which align closely with the PMDR roadmap that's going to be out there. And then secondly, with the IIGCC, we are working with Ceres to come up with a white paper that explains how these different frameworks work together. And so I think this idea of simplicity and convergence will get us to the right outcome, where we have a much more common way of talking about in the industry, which both GPs and LPs really are keen to go do.
Interesting. So in the interest of time, I'm going to shift gears a little bit to something slightly different. So Emmanuel, if I may ask, the human capital side of the transition, I think, can be more challenging, particularly in difficult to abate industries. What are some of your learnings and your experience, having worked both at KKR and before that at Schneider Electric, about how to decarbonize emission-intensive companies?
Yeah, so there's two aspects, basically. You have the technology aspect. On one hand, you need to get to a point where, for instance, you can, without any technology risk, produce at scale zero carbon steel, for instance, or without any risk, deploy very large electric vehicle charging infrastructure. So there's this technological angle, and then those are new ways to do. Because even if you do that green steel, you're not going to do steel exactly the same way you're doing it in the traditional way to do it. So it may be less labor intensive in some cases, and we see that, for instance, with the issues with the auto workers and the transition to EVs these days. So there is a whole chapter of transitioning the workforce, both the leadership and the people who are able to manage those new assets, and the workforce, because it's creating jobs, new green jobs, arguably. So it's net positive at the end, because, for instance, we didn't have gigafactories to make batteries, and any small gigafactories is 2,500 jobs. So those are new jobs that are net positive. But it's a transition, and you have to manage that very well. So you end up in the reskilling, retraining aspect of it, and you have to be very detailed on this also.
Thank you. So, on the workforce, and a question for both John and Chris, I think there's a tendency to forget the implications of the transition to the low carbon economy on workers, in particular in carbon sectors. How are asset owners such as yourselves, John, considering the social and societal impacts of transitioning in your decision making?
It's a very important issue to the New York City funds, to our boards, which are composed of union representatives of each set of employees, the cops, the firefighters, the teachers, and so on. And so how the workers are treated in the climate transition, the notion of a just transition, is crucial. However, we're allocators, right? So we don't directly own these private markets companies. We work through our managers. So essentially, we're communicating to our managers the importance of this, and what tends to happen is that issues arise where there are conflicts. And it, by the way, it's workers, but it's also impact on communities, during the earlier session on natural capital, there was the issue of indigenous communities that protect, I think, 80% of the world's biodiversity. So all of these issues are interwoven. We are still trying to figure out how do we address it. We can communicate it to the managers, but then the managers rely on the company management. So there's layers of connection here, and we have to figure it out as asset owners. How do we communicate it? How do we communicate it effectively? That we want to ensure that workers in the companies in which our managers are investing on our behalf are not that the transition's not happening on their backs, right? And that workers are benefiting from it as well as the climate in general. And with that, I'm afraid I have to go. I apologize. Thank you so much for including me.
John has another commitment. He's not leaving because he's having a terrible time.
I have another
decision to come back next year.
Okay. So, I mean, as we're nearing the end, so I'll maybe conclude with a final question. I think in recent times, the concept of financial versus double materiality, impact investing, I think it's become a lot more prominent, particularly in the climate and more broadly sustainable investing space. And it's a question for all of you. Is there a case to be made that the private market and private investments are more aligned with the concept of double materiality and impact investing simply due to the more direct nature of financing and having an impact at a very, very early stage versus public markets where companies are already in the secondary market and so the main impact, so to speak, has already been accounted for to some degree? Marc, I'll start with you.
Oh, great. Yeah, and I'll try to keep it quick. I think most definitely. I mean, particularly in Europe, we see a number of double impact funds that are out there, but the big driver of it are the LPs. And John mentioned it, but we have a number of LP clients who make their investment decisions that are in line with their ultimate beneficiaries. And so it's quite interesting to see how when they're actually thinking about a GP to invest in, it's not only around the returns, but it's also around making sure the values and the outcomes that those investments have are aligned with their underlying beneficiaries of the LPs. Thank you.
Emmanuel, any thoughts from you?
I think, the world is coming to the conclusion that it's fairly natural. So that notion of a trade-off between something that's sustainable and economic returns is that's over. That idea, right? So producing electricity with solar is the cheapest source of electricity on the planet. So you have to find that somewhere up in the food chain when you invest. Electric cars, give them another 2 years, and they're going to be way much cheaper than the equivalent in combustion engine, and more fun to drive, with more autonomy, with more everything better. So that the double impact notion is probably going to disappear because it's not an effort we need to make anymore. It's going to be very natural. Although to John's point, right? So the gentle pressure of LPs on making sure that we all do our homework on net zero plans for our portfolio company and all this is still a very healthy one. But I'm fairly optimistic. That's going to be kind of normal business for everyone to do that.
Thank you. And a final thought from you on this, Chris?
Sure. So the societal lens and the investment lens is embedded with everything that we do. We talked about it from a climate perspective, but maybe blending the last two questions to round it out. Once we get past the climate lens, as part of our diligence in our screens, we'll have an internal ESG screen. We'll use external folks to come in and help us out, and so you have a negative red flag screen factor, and there have been deals that we've passed on for some societal concerns. In addition, I think there's also kind of a positive screen or value add here in the U.S. Some of the federal and state and local incentive dollars that are floating around can be tied to disadvantaged communities. So you have a really nice opportunity to create value and have a positive community impact. And then just to give you an idea of the breadth of the markets and the investments that we're across, Wollemi, it's an Australian name and it's an Australian company. And so there are certain markets in Australia. There's a carbon market where indigenous groups have rights over projects, and they have to approve as part of the permitting process, essentially. And so making sure that our investments are conforming to those regulatory requirements, I think, from all aspects, the double materiality and the ESG lens is a natural fit for us as well.
Thanks, Chris. So with that, I'll conclude this session today. Thank you to our panelists. Please give a round of applause to